Welcome to PhillipCapital's Weekly Market Watch. The US S&P 500 has rallied more than 12% since February this year. The economic numbers are also picking up strongly, with the most recent non-farm payroll numbers pointing to an improving job market. Sentiments have driven the rally so far, and moving forward, the sustainability of the rally will be on investors' mind. Today, we have Mr. Liang Shiping, investment analyst from Phillip Securities, to tell us more. So Shiping, how do you explain the recent global equity upside momentum?
Of course, on the headlines, we do see that the market sentiment is pretty positive, supported by the improving economic numbers over in the United States. Fundamentally, I feel that the overall global economy is recovering steadily at the moment. However, I just want to highlight that the US 10-year swap rate traded below the 10-year Treasury yield for the first time in the history earlier the week before, and that actually helped sustain the equity rally. While swap rates and treasury yields have been converging due to the high level of government bond supply and increased demand by investors using swaps for meeting long-dated liabilities rather than committing capital towards buying bonds. Historically, yields on government bonds have traded at a discount to the derivative, as swaps are money market instruments, whereas the US Treasury reflect AAA sovereign risk. So, as the long end of the Treasury market got sold off and the global equities rallied over last week, this reflects the reallocation of money from US bonds to global equities within the recent trading window. Therefore, one possible explanation of the recent upside in equities is that investors are switching out of treasuries into equities, and it is doubtful whether that will help to sustain the rally we saw.
In this case, what are the downside risks in the market?
Firstly, let us talk about interest rate risk in the United States. We know that yields move in an opposite direction from bond prices. And as we are speaking, the 10-year Treasury yield is approaching the 4% mark, which is considered to be a fairly important psychological threshold. The historical average for the 10-year Treasury note yield is 7.31%, well above the current level. Right now, the market is trying to tell us that it is time for yield to start rising again, and investors are becoming less willing to hold onto a low-yielding long-term bond. This is going to drive up the mortgage rates in the United States, and homeowners will have to pay sharply higher rates when their adjustable rate mortgages reset. Secondly, the US is still a long way off replacing the 8.4 million jobs erased in the Great Recession, and more than 11 million people are drawing unemployment insurance benefits. Even though the employment picture is improving based on the most recent non-farm payroll numbers, we should not get overly optimistic that job market recovery is a sure thing. My concern is that based on the above 2 points, if the job numbers does not improve sharply over the next few quarters, we are going to see the mortgage default rates going up again, and more write-downs will be in the waiting.
Do you think the investors should start to reduce their equities positions?
Yes, I do think that investors can consider taking partial profits off the table at the moment. If the next round of correction does come along in the next few weeks, investors can look out for markets with attractive valuations like the South Korean equities, which are trading below its 5-year average price-to-book ratio. On the other hand, countries such as India seems to be overpriced at the moment, and we do expect more upcoming tightening measures from Reserve Bank of India. Unit trust can be a good choice for investors to gain exposure in this case.
Thank you, Shiping. That's all for you today. Tune in next week for more market updates.